Thank you for joining me. I'm Alex, and I would like to do an analysis of Viacom. And I know how ironic it is to make a video about Viacom on YouTube, but here we are. So they do TV. They own MTV, Comedy Central, a bunch of other channels. They do a lot, and they don't like their content being on YouTube, which is why it's so ironic. So current price is $24, which gives them a market cap of $9.9 billion. Dividend yield is 3.4% with a payout ratio of only 21%, which is amazing. Revenue $12.8 billion, earnings $1.5 billion, which gives them a PE of 6, which is amazing. Total assets $23.7 billion, total liability is $15.2 billion, and total stockholders' equity of $8.5 billion, which is up 15%, which is also pretty amazing. So, in summary, I would say that pretty much everything looks amazing here, and I don't really see myself not buying this stock at a PE of 6 with a 3.4% dividend yield and a 21% payout ratio. I think those stats are just too good to pass up the stock, even though I don't agree with a lot of things they do. But overall, the problems that this stock has are that the revenue is shrinking, and it's not just from the previous year. It's pretty consistent and trending downwards. The earnings are also fairly consistent and trending downwards. So that explains why the stock is so cheap. They don't really have a plan to turn things around. However, they were one of the early adopters with having their own platform on the internet and having their shows there. So I would say that they're doing fairly well in the advertising on their own website with their own shows. So as ad rates increase, I could see them turn things around. And I do see them sticking around for a fairly long time. So I don't think that the revenue trending downwards with no plans to stop it is really a huge problem at this point. Obviously, negative 10% on the earnings is a much bigger point, but that is a fairly minor thing, I would say, at a PE of 6 especially. So I would say that if you have a sufficiently long horizon, that even just the dividend yield is going to make you money before the company goes broke. That's kind of how I would summarize the whole thing. So if you're a growth investor, obviously with no growth, you're kind of out. If you're a dividend investor, 3.4% dividend is pretty nice. 21% payout ratio is amazing. And the balance sheet looks all right. It doesn't look great, but it looks all right. And so I think for a dividend investor, this stock makes sense. I think for a dividend investor, the stock makes more sense than for a value investor. But even for a value investor, revenue is good, earnings are good, PE is amazing, dividend yield is amazing, and the balance sheet doesn't look bad. So for a value investor, I would also recommend this stock. It's just that it's one of those that you kind of have to keep an eye on because you don't want to be stuck with it if things turn even worse. Now, I really don't think they will, but, you do have to keep an eye on it. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.